Hey, boys and girls, it's Yakir here, and of course, I've been thinking. So I've been thinking about an email I received telling me that during the summer series, I've had many financial guests on who specialize in investing and saving for retirement. And the email goes on to ask, what about the rest of us who have saved and invested and who are now retired with substantial savings? So I've invited Benjamin Brandt, an advisor from Capital City Wealth Management, who specializes in wealth management for retired folks. So that's what we'll yak about today. What's up, everybody? David Yakir here for Yak About Today, hoping you are better, healthier, and more informed than any generation that came before. So if the years 46 to 64 means something to you, then this is the place you want to be. Now put your headphones on, go for a run, and listen to what we yak about today. And we are back. I'm David Yakir. You're listening to Yak About Today. And as promised, for all you people needing more financial advice, I've got Benjamin Brandt here. He's an investment advisor with Capital City Wealth Management, Inc. And our purpose today is we need advice. That's our purpose. Anyway, welcome, Benjamin.
Hey, thanks, Dave. Thanks for having me on the show.
So, we've been spending, at the beginning of the season, I sort of named this Yak's summer season type of thing. And during the year, most of my listeners are always emailing me about financial advice. And they have so many questions. Some who are planning to retire, some who have retired and really are finding they may not be able to last. So there are all these different questions. People don't know what to do with their Social Security, when they work, that type of thing. So we're hoping that we can really work our way through some of the questions. But first, why don't you give the audience a little background so they know who they're listening to?
Well, sure. My name is Benjamin Brandt. I've been a financial advisor for about 10, 11 years. And when people ask me what I do, I say that I teach people how to retire. Our firm and our podcast and the webinars that we do and the classes that we teach at the local community college, everything we do revolves around retirement exclusively. We don't work with very, very old people. We don't work with very, very young people. We don't work with executives or life insurance or anything like that. We only work with people that are looking to turn their portfolios into income. So we're fee-only fiduciaries. We don't sell any financial products. We only give advice for a fee. So I don't know about Florida, but we're very, very unique here in the Midwest where we primarily operate. So we talk about retirement all day and all night long.
All right. Well, you should know Florida because obviously Florida has a population that's very much your target audience. So hopefully you'll come down here and help us in person.
Well, absolutely. So, in the Midwest, we're known for our vicious winters. So if you have means and you're retiring in North Dakota, you're going to have a house either in Florida or in Arizona. So yeah, we're familiar.
That's right. So, there are a lot of retirees. Now, just the demographic breakup of the audience, we're seeing, the baby boomer generation controls something they say about $2 trillion in assets, type of thing. But in our research, we're seeing that, there's a big percentage of the population that's hitting that 55, 65 age, and they're caught in between. Some of them are unfortunately never got a chance to save because they put so many kids through college and there were a lot of expenses, and maybe they only have the house as an asset. And some people actually have less than that. And some people thought they had saved enough money, but when it comes down to it, they realize at a certain age they have to work. So there are sort of different categories here. So why don't we take, let's say somebody, I'll give you an age, 55. They have a house, they have some 401k savings, but nowhere near what's necessary. They always say you need $1 million or $2 million because we're going to live so long. That's the big thing now. We're all living till 90. In the old days, you lived to 75, so you had enough money to make it from 65 to 75. What's the strategy at, let's say, a 55-year-old that's going to retire in 10 years?
I would say 55 and retiring in 10 years or less, and they don't have the biggest helper when it comes to retirement savings, which is compound interest. So they don't have that working for them anymore. Even if they ramp up their savings, it's not going to compound enough to get them probably to their goals. And we see this quite a bit. People that write into our show, Retirement Starts Today Radio, and have the same question. So what I would say is, if you've got enough lead time to when you think you might retire, start thinking about doing what we would call a practice retirement, where we take as many days off as we're allowed, don't carry over any vacation, and try to live some of that retirement lifestyle while you're working, so that we're able to leverage the income that we're getting from our job, and we're able to leverage that into living some of this retirement without having to extinguish any of our savings. The other thing you could do when we're practicing retirement is that we could try to create for ourselves a lifestyle that we don't need to retire from income-wise. This is very difficult if you're in any kind of manual labor, but if you're an engineer or work on the internet in any capacity, creating for yourself, whether that be consulting work or something part-time that you could see yourself doing well into your later 60s or even 70s. We've had some clients that have had some great success with this. So we would say craft for yourself a lifestyle that you don't feel the need to retire from, something that rewards you. If you feel like you still have something to give back to your career, if you have the need for a guaranteed income source as far as an earned income because your savings isn't where we'd like it to be, those are all factors that we should consider well ahead of the time that we're supposed to retire, because as you know, David, sometimes you retire and sometimes you get retired. We just had that happen in Bismarck with a coal mine that's laying off 300 people. So if you're not proactive and working on some of these things before you need it, you might end up being reactive, which always means trouble.
I mean, there's two things here. So one thing you said earlier that's interesting is when you said practice retirement. What I find interesting about that is that you sort of just stop and is it about analyzing what you're actually spending on? So if you have a couple of weeks or you have a month or whatever it is, you're sitting there you're getting up in the morning, and whereas when you were working, you went out for breakfast or you went out for dinners or, you bought new furniture. Is this about sort of watching your expenses and understanding your expenses? Is that what you were saying?
Well, there are two things that we've talked about a lot on our show. One is a practice retirement. That's where we work and retire at the same time. We do a bit of both. The second is the retirement rehearsal. There's over $50 billion of unused vacation pay every year that people just don't have access. They don't use it in any capacity, and they just lose access to it. It doesn't roll over. It disappears. $50 billion a year. Now, what we encourage people to do is called a retirement rehearsal. You could also call it a staycation, where you take 2 weeks off of work on the run-up to retirement and you stay at home and do absolutely nothing. That is, to answer your question, how you analyze what your true spending patterns are. I think, human beings, Freakonomics is one of the most popular podcasts on earth. And the first rule of Freakonomics is that human beings are motivated by incentives. We need to be incentivized to save. So we're thinking about the trip to Fiji or taking the kids to Disneyland. That's how we're incentivizing ourselves to save. But if we put a pen and paper to that, that's going to be 0.00001% of our actual retirement. Our actual retirement is going to be a random Tuesday afternoon when we're sitting in the living room watching the Today Show with our spouse. So we would encourage people to have a staycation, a retirement rehearsal, and spend 2 weeks at home pursuing your hobbies, figuring out what it is that you're going to occupy 40 hours a week that you don't have occupied anymore because you've retired. So you're pretending, you're rehearsing your retirement. And that's going to really give you some valuable data for your retirement plan, in that how much are we actually spending on those random Tuesday afternoons, not the vacation, not the one-time thing, the actual days of retirement, because we're pretending to be retired. Now, if we go back to our financial plan and find out that we were spending much less than we thought, well, hey, that means we get to retire sooner. But it also gives us valuable data in the other direction, is that, boy, these hobbies that we're pursuing are much, much more expensive than what we have outlined in our financial plan. We've got to go back and run these numbers and maybe work longer or something like that. But even more than the data, what I want you to evaluate when you're rehearsing your retirement is, are you bored? If you're bored that is a massive red flag, and we need to reevaluate the entire retirement plan, because how do we usually alleviate boredom? We try to spend our way out of boredom. We go on Amazon, or we try to go to the local sporting goods store and buy a new hobby, and that can be really disastrous to your retirement plan overall. So evaluate your spending and find out if you're bored. Those are two big things that are not financial at all, as far as having assets in the bank, but are super important for retirement planning.
All right, I got another question on something you just really spoke about, and then we're going to go to break after you answer it. When you talked about the 300 people being laid off at the coal mine, that reminded me of certain statistics of what happened in the 2008 Great Recession. And that was that the majority of people that lost their jobs were 55 plus. And many of them couldn't find their way back into the workforce, because they were pushed out. Now, many of them are getting lower level jobs, or like you said, doing part-time consulting, which is interesting because, as I've learned, everybody's a consultant now if they're over 55. And, but I don't know how they think about it. So if they are lucky enough to actually manage to get back into the workforce, is there a normal pattern of savings? I mean, many people are told, well, you just have to work. Find a job that you can work at, that age isn't so significant, a factor, and continue working. Is there a strategy to help them get out of it? So if they're first going back in, they don't really have the money, they're going to have to work, but they maybe can't work past 75 or 80. Is there a strategy there? And actually, can you hold that question? We got to take a break right now, and when we come back, you can think about it and answer it for the audience. I'm David Yakir. You're listening to Yak About Today. We're going to take a break now for our sponsor and our advertisers, and we will be right back. I want to take a moment to talk to you about New Vision Eye Center. For the last couple of years, they've been a sponsor of this show, and I couldn't be prouder. I've met so many people that have walked up to me and thanked me for recommending them. I hear all sorts of stories about how they've worked miracles. And as you know, I've been a patient of New Vision Eye Center for years. So when I say go see Dr. Minotti, Reinauer, Tate, and O'Brien, it's because I wouldn't trust my eyes to anyone else. Finance for all you soon-to-be retired people, all of you retired people, and especially me, who doesn't know what he is. Anyway, so Benjamin, I asked you earlier about people who were forced out of the workforce at 55, 56 years old during the Great Recession, and they're finding their way in at less pay, and retirement doesn't look like it's any place in their future. And I think the problem is they don't know how to think about their money.
I think I can help. I wish I had some really attractive response. You buy this certain investment, or you invest in this certain way, and you're guaranteed to have some amazing returns, and all of your woes will be alleviated. Really, there's no easy answer to this. Slow and steady wins the race. Keep investing in low cost index funds and ETFs. Keep investing in a balanced portfolio of stocks and bonds. But I think where I can be the most valuable is to tell your listeners what to avoid. A lot of times when people re-enter the workforce and they feel like they're behind of where they should be with their savings, they want to find that quick fix. They want to find a Bitcoin or the next Netflix or Amazon, and they go all in trying to catch up return-wise by cranking up that risk dial. And that only works if you win. If you lose, you're worse off than when you started. I've had clients that do. I've come across people in my practice that have done zero money down financing on a rental property or something like that with no prior knowledge or no business investing in real estate at all. So if you think that you need to catch up, you've got to be extra aware, extra cautious, because that means you're going to be looking for outsized risk. Because outside risk is the only way that we could ever get outsized returns. So I would encourage people, slow and steady wins the race. And if you are in a volatile industry, especially natural resources or anything that would be involved with being funded by grants, you're already in a volatile industry. So you need to be proactive and start to make some of those connections. Maybe even hire a job coach to find out. We did an episode a few months ago about starting a business after age 50 that your listeners could check out. We interviewed a job coach about how I could be proactive and maybe find some of these consulting gigs, or how do I start that business to be proactive should you get laid off, or should you lose your job and have to go back to an entry-level position as an option. So being proactive, networking, making some of these connections. If this terrible worst-case scenario happens to you, you've already laid out a plan as to how to get out from under it.
All right, let's jump past retirement for a second. One of the questions I actually recently got from a listener who has money, retired with money, actually sold a company, and is right now thinking that she is very comfortable for the rest of her life. But what's making her comfortable is how safe her investments are, mixed in with the stock. I'm sorry, I'm phrasing this wrong. She is afraid that she doesn't have enough money for the future. She retired young, and right now she's split between safe investments and riskier investments. And recently the stock market, exploded, and she started seeing returns on that money, that were extraordinary. I remember her saying, "Oh, I made $25,000 today," that type of thing. And she feels that she needs that kind of risky investment to really keep her situation going. She's may live a long life, but she doesn't know, does she stay safe and cut down on living expenses and try to make it through for the next 25 years? Or does she stay with some risky investments?
Well, I'm the perfect person to answer that question, because that's what I do for clients day in and day out. We take their life savings and we turn it into income for them through using index funds and ETFs and super plain vanilla investments. We believe in low-cost investing, but she has to do both. She's got to have about half of her portfolio in lower risk assets. Those would be bonds and cash and things like that. And then half of her investments in higher risk assets. That would be stocks and international stocks and small companies and big companies and you name it. And then in the middle, maybe some real estate or some utilities that are not either stocks or bonds and are medium risk. You've got to do that because, one, if you think the stock market is going to go up, it probably will over time. That's a relatively reasonable thing to say, but it doesn't go up consistently enough for us to collect monthly income off of. We might have to sell 10% more of our stocks, of our shares, if the market is down 10%, right? And if you do that long enough, you'd run out of money. So we need to have some of our portfolio that's lower risk and provides consistent returns. So we spend on the low risk side and we grow on the high risk side. And then naturally our 50-50 will become out of balance eventually because we're spending one side and not spending the other side. So we do something very simple called rebalancing. We just rebalance back to our original tolerances. We feed our investments that aren't doing so well with the profits from our investments that have done well. Now, the reason that we have to have risky investments is because retirement is we don't know when that retirement is going to end. It could be 5 years, it could be 50 years. If your friend retired at 50 and she has amazing longevity, she could live until 100. That's 50 years of retirement. If you simply look back 20 years at what your house was worth, or 20 years how full you could get your grocery cart at the super value for $100, you can see that inflation is a real risk for people that are living off Social Security or living off a pension. Those are not likely to keep up with inflation properly. We need to look to our portfolio to do that for us. And the only way that we can do that is to pursue an investment return that would beat inflation over time. Stocks, long-term, absolutely do that as long as you have enough time between you and the time you need the money. So half stocks, half bonds, generally speaking. If you're more risky, 70% stocks, 30% bonds. If you're less risky, 50% stocks, 50% bonds. Anything in that realm should properly hedge inflation. 50 to 60% stocks over time should hedge inflation properly so that I'll make up a number, your $5,000 a month of income will always feel like $5,000 a month of income, even with inflation nipping at your heels every year.
So how much do you think well, I guess the answer is going to be relative. I was going to say, if you lived a nice middle-class life, you had a nice 3-bedroom house, 2 kids, went off to college, they're living themselves. The house is, I guess, depending on where that house is situated, is worth a certain amount. You have probably not $1 million in your 401k. Let's say you have 400,000 in your 401k, and you have a house that may be worth 500,000, right? And both of them are considering retiring at 65. Do they have the assets that, if invested right, can take them into retirement?
Well, what you're really asking is, how much do I need to retire? I think,
Yes.
and the only real answer to that question is it's all relative, right? We've had clients with millions of dollars that have an extremely high income needed, and that might not be several $1 million might not be enough to get them through their retirement if their spending needs are too high. On the other hand, if we have a client that has a very strong pension, maybe they're a teacher and they have a very strong Social Security, they might not ever need their portfolio investments because their guaranteed income sources are meeting their desired income needs. So it's really not how much do I need to have. You need to reverse engineer that number from how much do I need monthly to achieve my ideal retirement. There are rules of thumb like the 4% rule. So $1 million at 4% will provide $40,000 per year, and that's indexed to inflation. Not the best way to go. I think there's better ways where you can achieve a higher spending rate than 4%, but it's a rule of thumb. 40,000 per million, 20,000 per 500,000. It's an easy way to sort of do that kind of math in our head. So if you need 40,000 a year plus Social Security, well then about $1 million or 800,000 factoring in Social Security should be able to get you through a 30-year retirement. Now, talking about your home's equity, a rule of thumb is you can probably use about half of your home's equity to buy an annuity. So take half your home's equity, go to an annuity calculator and plug that in and say, okay, that would potentially provide me with $400 a month for the rest of my life. The reverse mortgage company is going to take the other half as collateral for the mortgage.
All right, Benjamin, I need to stop there. For the broadcast audience listening to WAXY 107.9, 1370 AM and 101.7, we got to go now. And this is David Yakir, and you're listening to Yak About Today. And Benjamin, just one last thing, do it quickly. If people do want to get in touch with you and ask you questions and you can advise them, give them a number.
Yeah, well, I would say planning your amazing retirement starts today at retirementstartstoday.com. That's our website. Search Retirement Starts Today in iTunes, and you'll find our podcast. We love teaching people how to retire. All
right, this is David Yakir. Broadcast audience, bye-bye. Love you. Peace. And we are back. You're listening to the Yak About Today podcast. I hope the broadcast listeners stayed with us and went on to yakabouttoday.com. I'm here with Benjamin Brandt, investment advisor, Capital City Wealth Management. And I have some questions, of course. I'm not in finance, and quite honestly, Benjamin, I never took a finance class in my life. And the fact that I've made it through life in a sane financial way is always surprising me, although the life's not over, so I can screw it up from here on in. There was something that I read or you said, something about dynamic investing or versus linear investing. And for those people who actually have the money and are investing, are these two different strategies, or are there two different ways of looking at it?
It's a different way of looking at it, and I think it's a misconception about how we spend money in retirement. For most people in their retirement budget, there is some wiggle room between your discretionary and your non-discretionary investments. And I think we can use that to our advantage when we think about what is a sustainable rate of spending out of our retirement portfolio. So thinking back to your friend that wrote into the show, and she had some concerns about running out of money. I think that during a good market like we've had now, we should really evaluate what our retirement budget is and use that to be proactive about where we could cut our budget if the market, when the market eventually turns over, because it doesn't go up in a straight line forever. It's eventually going to roll over, and we're going to have bad markets. It's the only way we get back to our average return, right? If it's a pendulum swinging above average, we got to go back to below average to get back to our average. So eventually we'll have below average returns. If we decide ahead of time, and we would call this dynamic retirement spending, and we said, okay, if our portfolio drops from 500,000, if it drops below 400,000, and you can just create an Excel spreadsheet. We call this guardrails. We do this for our ongoing planning clients all the time. If I decide to cut my retirement spending from 5,000 down to 4,500, a 10% cut, if my portfolio drops below 4,000, I'm going to be that much more likely to rebound when the market rebounds because I'm asking less performance out of my portfolio. So we would call that dynamic spending. Most people think of their retirement planning as linear, like in a straight line. I'm going to spend an inflation-adjusted $5,000 a month for the next 20, 30, 40, 50 years, and I'm never going to change regardless of what the market does. I kind of liken that to closing my eyes and sprinting at a brick wall, knowing that the wall is there, and I'm just going to hit it eventually. But what dynamic spending is opening your eyes and saying, the market's not good right now. Why don't I just slightly reduce by 10%? And then that can basically ensure that I'm that much less likely to run out of money because I reduce my 5,000 to 4,500. If the market gets worse, I reduce to 4,000. If the market gets worse, I reduce to 3,500. Now we know eventually the market's going to bounce back. It always has. Through the Great Depression, through the financial crisis, eventually, it only took about 2.5 years during the financial crisis to bounce back. So if you've got half of your portfolio allocated to bonds and cash, and you're reducing your spending gradually, you're going to rebound with the rest of the market, and you're not going to be any worse for the wear. So don't think of your spending linear, like a straight line. Think of it as dynamic. When the market gets better, I can spend more. When the market gets worse, I'm going to spend a bit less. And that's how us as financial advisors, we should have that built into the plan. And then there's a certain amount of accountability with our clients that we know what to do when the market gets bad, before it gets bad.
So based on your experience, and you deal with a certain clientele, so you are advisors, and let's say they have a certain amount of money, and I'm asking a question, by the way. I don't even know if the question is right, but is there a certain rate of return that you aim for? So you have a client that spent their lives putting away exactly $1.5 million, right? It's being invested. They are retired. Is there an expectation or a goal toward the return, or is it really different, again, for every single person because you're investing differently for each person depending on their needs? I think I just answered this, but go ahead.
Yeah, I would say when we think about our portfolio, we need to recognize that return and risk are going to be joined at the hip. Any extra return that we get over what we would consider to be an average return for a 60-40 stock to bond portfolio means more risk. There's just no other way about it. We can't get return without risk. So I would say after fees, after you pay the mutual fund company or the ETF company, after you pay your advisor, you're probably looking at, let's say, 5% return. Now, that might be way too conservative for an aggressive investor. It might be way too aggressive for a conservative investor. So what you want to define for yourself is what is your, just like when you're taking an Advil, what's the minimum effective dose of risk? So how we derive that is we look at your retirement budget and we say, how much are we going to need to survive and how much are we going to need to have our ideal retirement? That's going to give us a range of numbers. Now, what we do with that is we look at what you've saved so far and we run a Monte Carlo analysis, which is, it just gives us a likelihood of success of achieving those retirement income goals. And then that tells us how much risk we need to take. So you just have to understand that if you hit all of your ideal perfect retirement goals and you could do that at a 2% return, understand what that means if you attempt a 5% return. You're potentially jeopardizing part of the plan to get some additional return. That there's a term in economics called marginal utility. There's not going to be any extra happiness in that extra return, but there is potential unhappiness in the form of risk. So you need to figure out, just like when you're taking pills from the pharmacy, what's the minimum effective dose of risk for your unique financial situation?
And is this something that's a plug and play? So you're sitting down with someone and you ask them the basic questions about how do you want to live? Are you going to downsize and keep it simple? And they say, look, this is how we want to live, and we estimate our expenses to live that way. And you plug that in, and by plugging it in, you understand that, okay, to live, and they live conservatively, they'll need $3,000 a month. No, they can't do that. Let's say they need $10,000 a month or $8,000 a month. And then you plug that in, and does that all of a sudden work its way into how much risk you should take and the type of investments? Or is it through conversation and your knowledge and your experience that you sit there and say, look, first, for your situation, you need a balance of, probably safe investment of 60%, and will risk 40%. I think what I'm asking is this a plug and play situation, or are there unique characteristics that your judgment plays into? I think what I'm asking is, can anybody do what you do if they have the right system in place? Or based on your experience, do you provide a additional, service based on your extensive knowledge? Did that make sense?
It does. I've got a couple of things I could add there. Anybody could do what I do. Absolutely. There's Vanguard and Fidelity both have retirement calculators that tell you how much, what the ideal portfolio could be. And then, of course, they would expect you to invest that with them. And there's, fees attached and things like that. I think the biggest thing an advisor adds is accountability. We are not great as people to being accountable to our own actions. We invest with emotion. And one investment mistake avoided pays an advisor's fee for a lifetime, especially when we're talking about, a few $1 million of net worth. So I would say accountability, creating a plan and then holding you to it. Warren Buffett also often talks about being greedy when others are fearful, and fearful when others are greedy. Your financial advisor, if he or she is worth anything, should be able to do that. Now, as far as the plug and play, I have conversations with clients all the time, prospective clients that say, I only need $3,000 a month. I'm used to making $7,000 a month, and that's all we need to plan for is $3,000 a month. I've grown a fantastic BS detector over my decade or so of being a financial advisor. So, and your listeners could use this on their own financial plan. If you think you only need $3,000 a month and you are living on $7,000 a month, what should that tell us? That should tell us we are putting money into savings every month, and our savings account is growing and growing and growing. If that's not the case, we've got a disconnect somewhere. Or if someone has ever-growing revolving debt, if they have money on their credit cards and they think they're living on less than they make but have growing credit card debt, well, we've got something that isn't quite adding up, and your BS detector should be going off. So looking for some of those red flags. Do you have growing savings? Do you have growing credit card debt? You need to really evaluate that on the run-up to retirement, because the amount of money that you'll need from your portfolio is probably going to, at least in some way, dictate how much risk you're going to need to take. So if we look at a half stock, half bond portfolio and say, okay, we think long term we can hit 5% return. If you need 9% return just to cover your essential expenses, you're going to need to take a lot more risk in that portfolio, which means you're a lot more likely to run out of money. So measuring those things with some maybe like a disinterested third party, someone that can look at it with no emotion at all. Of course, we're kind to people, but we're the numbers don't lie. That's where you might want to look at hiring a financial advisor, even maybe for a second opinion. If you think you're totally capable of running your money yourself, which many people are. I have a lot of extremely intelligent people that simply hire me on an hourly basis for a second opinion. There are many, many people that are capable of doing our work themselves and saving the fee. I would say that's maybe 10% of the population. You've got to be looking in the forums and listening to podcasts like yours and mine, David, to be constantly educating yourself about it. But it is possible to do it yourself.
So I think the last question I have, and I think this came from a dinner party I was at, where somebody was talking about the Schwab commercials, where the financial advisor takes certain fees, and Schwab only charges $4.95 and for an investment and that type of thing. And I know it sounds ridiculous, but I don't think people understand how financial advisors make their money. Is it through the amount invested, or is it through a certain fee for advice?
I tell you, it's everything under the sun. There are advisors that sell products based on hidden fees. They're paid by the insurance company, or they're paid by the brokerage company. The client never pays them directly. Much like our medical system, you don't know what it costs. Thus, the cost is inflated because the end user never sees it. So I would say, you want to ask your advisor, do I pay you out of my account, or does the insurance company pay you? You want to pay your advisor because that provides transparency needed to evaluate, boy, I'm paying this guy $10,000 a year. Am I getting more than $10,000 a year worth of value? If you don't pay your advisor directly, you'll have no way of knowing how much you're paying versus the value that you're getting. So as far as like a Charles Schwab or a Fidelity commercial where you're paying per trade, you may never need to trade. You may need to trade all the time. That's just you're measuring one small portion of a financial plan that really has nothing to do with financial planning. We need to separate where investment starts and financial planning begins. I'm of the belief that financial planning is much, much, much more important than investing, because we can't control what the stock market does, but we can control our behavior.
So the way people should look at it, and I think the way I look at it now, is, look, I have to pay my doctor, I have to pay my dentist, right, for keeping me healthy, and I suspect you have to pay your financial advisor to keep your finances healthy, and you could always get a bad doctor, you can always get a bad finance guy, but that's the way I think people should look at it. And people do have trouble, by the way, looking at the money that's going to the advisors, to the investment people. I don't think many people really understand how it works, but anyway.
And that's by design. That's by design. It's important to understand that, if your advisor hands you a 270-page prospectus for an investment product that you're buying, you need to ask yourself, is this prospectus written for my benefit, or is it written by some attorneys to protect some CYA insurance? You really want to be simple. You want to be transparent. You want to pay someone X amount of dollars or X amount of percent of my portfolio for X value. You want to hire them on a month-by-month or quarter-by-quarter basis. You want to be able to fire them as soon as you're not feeling, getting that value. Locking yourself up into a 5 or 10 or 25-year contract for some ambiguous fee that you don't pay directly, I would avoid that at all costs.
All right. I really want to thank you for coming on, Benjamin. That's Benjamin Brandt, investment advisor for Capital City Wealth Management. And by the way, we have to have you back, because what happens after the show is I actually get emails with questions, and I sort of accumulate them. And when I put enough of them together, you'll come back and you'll answer all the questions.
Absolutely. I would be happy to ask questions. In fact, Florida just came up this morning. I was interviewing someone about the do's and don'ts of buying timeshares. So,
let's go into that. We have time. Go,
okay.
Hit it. Because a lot of people here, this is a big timeshare community, and everybody's trying to dump their timeshares. In fact, I think there's a new business that's been advertising on TV lately about getting rid of your timeshares. Call so-and-so. So give us the lay of the land there, and then we'll take off.
Yeah, there's actually a Dave Ramsey, who's an extremely popular finance personality on radio and podcast, has a new service. I don't recall what it's called, but he's very anti-timeshare, and he has a service that will sell it for you. But, I was really amazed about the secondary market of timeshares. I was interviewing this expert. Her name is Lisa Ann Schreier, and her blog is The Timeshare Crusader, and talking about how you could, rent a timeshare before you actually buy it. I had no idea that was even a possibility. So our conversation was much more on the buying side than the selling side. But anecdotally here in Bismarck, we were evaluating a contract that a client had bought, and you were able to buy her entire year's worth of points on eBay for $1, basically, and how to navigate your way out of these contracts. Some of these are not American companies, so you can't call the Better Business Bureau. You have to find the other country's version of that, and it's really stressful situation, because there's a lot of money and a lot of annual fees tied up in some of these contracts. So selling them on the secondary market, she was able to share some interesting links with me. I wasn't aware there was a Zillow for timeshares. Zillow, you can type in your address and it approximately tells you how much your house is worth.
That's right.
This website is called Sharket, SHARKET.com, and it's basically the Zillow for timeshares. You can find out exactly how much your timeshare is worth, or the timeshare that you're considering purchasing. Put the address in there, put the company in there, and it'll tell you if something recently has sold for X price, and then by comparison. So a lot of really interesting resources out there. We're going to interview her again at some point in the future to find out the other side of the coin. How do I sell my timeshare?
Well, I'm hoping that not too many sell their timeshare, because everybody in this area always offers me a couple of weeks in their timeshare because they're not using it. So I sort of like that. But
the only thing better than a timeshare is a friend with a timeshare.
That's right. Exactly. You have no responsibility. All right. Once again, I thank you, Benjamin, for coming on. This is David Yakir. You're listening to Yak About Today, and we'll be back with you next week. And I think we have somebody on who's going to talk about memory. So if you're having memory problems, listen next week. And again, thank you, Benjamin. This is David Yakir. Over, out, peace.
Take out the papers and the trash, or you don't talk back.
Just finish cleaning up your room. Let's see that dust fly with that broom. Get all that garbage out of sight, or you don't go out Friday night. Yakety yak.
Don't talk back.
Don't you give me no dirty looks. Your father simply knows the cooks. Tell all your hula friends outside, you ain't got time to take a ride. Yakety yak.
Don't talk back.